There is a specific three-digit number that strikes fear into the hearts of pretty much every adult I know.
Oh, yeah.
It's the invisible hand that dictates whether you get that apartment, what interest rate you pay on a car, or, if you can even dream of buying a house.
You're definitely talking about the credit score.
Exactly, the FICO score. And usually when we talk about FICO, we talk about it like it's this mysterious judgment from above.
Or some government bureau, yeah.
We obsess over the number itself.
Yeah.
How to raise it, how to protect it. But we rarely stop to think about the company that actually generates that number.
Which is a huge oversight, because if you really look under the hood, FICO isn't just a calculator or some passive utility. It is an incredibly sophisticated and, frankly, a somewhat ruthless technology company.
And a wildly profitable one, apparently. So today we're doing something a little different. We are ignoring my personal credit score, thank goodness for that, and we are looking at FICO's bank account instead.
Mm-hmm.
We have their Q1 fiscal 2026 earnings report right here. It just dropped on January 28, 2026.
And let me tell you, for a company that was founded way back in 1956, the numbers they are putting up in 2026 are, well, they're startling. This is not a sleepy legacy business.
That's the mission today.
Yeah.
We need to decode how a 70-year-old company is posting the kind of growth you'd usually see from a Silicon Valley startup.
Right.
We're going to look at the money-making engine behind the score. Because when I first glanced at this report, I saw the revenue numbers, and I honestly had to double-check the ticker symbol. I thought, wait, is this a hot AI startup or a credit bureau?
It's a bit of both, and that's the magic. It's really a tale of two cities, two very different business models working together.
Okay.
You have the utility-like power of the credit score, which we all know. And then you have this burgeoning software platform that's quietly transforming how banks operate behind the scenes.
Okay, let's unpack this, because the headline numbers are big, but the real story is definitely in the details. Where do we start?
Let's start at the very top, the headline performance. For the first quarter of fiscal 2026, FICO reported revenues of $512 million.
$500 million in just 3 months.
Precisely. And that is up 16% from the $440 million they did in the same period last year.
Wow.
Now, 16% top-line growth for a mature company is already really impressive. But look at the profit.
I'm looking at the net income. It says $158.4 million.
Right. And if you break that down to earnings per share, the GAAP EPS, it came in at $6.61 compared to $6.14 last year.
So they are making money,
Yes.
and they are growing that money efficiently. But the question is, how? I mean, is it just that more people are checking their credit scores?
That's part of it, but not in the way you might think. This brings us to the first major engine of their business, the Scores segment.
The powerhouse.
Yeah, absolute heavy lifter. In this quarter alone, Scores revenue hit $304.5 million.
Whoa.
That is a massive 29% increase year over year.
Well, let's pause there. 29% growth. For a legacy product that has been around for decades. I mean, that is practically unheard of.
Yeah.
Usually products that mature grow at, what, the rate of GDP? Maybe 2 or 3%?
Yeah.
How do you get 29% out of a credit score?
That is the billion-dollar question. And to understand it, we need to break down who is paying for those scores. FICO splits this into B2B business to business and B2C business to consumer.
Okay, so B2C is the consumer side. That's like when I pay a monthly subscription to an identity theft app to see my own score, right?
Yeah.
Or use myfico.com.
Correct. Now, the B2C side grew about 5%. It's healthy, largely driven by what they call indirect channel partners.
Ah, so like your credit card company showing you your score in your monthly statement.
Exactly. They pay FICO for that privilege, but, 5% growth doesn't get you to a 29% total lift.
So the consumer isn't the main driver here, it's the banks.
Exactly. The rocket fuel is on the B2B side. This is when a bank, a lender, or a car dealership pays to see your score because you applied for a loan.
And that revenue.
It skyrocketed 36%.
36%, that is massive. Why are banks suddenly spending so much more on credit scores? Is the economy heating up that much?
The report gives us two very specific reasons, and it's a masterclass in business strategy. First, they cite an increase in volume of mortgage originations.
Okay, so that's market forces. Mortgage rates stabilize, people start buying houses again, refinancing picks up, more applications.
Right. More applications mean more credit pulls. Every time you apply for a mortgage, the lender pulls your FICO. Cha-ching. FICO gets paid. So volume is up.
Yeah.
But, and this is the critical piece, they also explicitly cite a higher mortgage origination scores unit price.
I see what you're getting at. They didn't just sell more scores, they sold them at a higher price.
Exactly. They raised the toll at the toll booth.
That is the textbook definition of pricing power.
It is the holy grail for investors. I mean, think about basic economics.
Yeah.
Usually, if you raise prices, demand drops. Or if you want more volume, you have to lower prices.
Right.
FICO managed to raise prices and benefit from increasing volume simultaneously.
That really speaks to the moat around this business. If
Yeah.
you're a bank and FICO raises the price of a score by $1 or $2, you can't just say, the FICO score is too expensive, let's use something else.
You literally can't. It is the industry standard. It's built into the plumbing of the financial system. It's required for securitizing mortgages to be sold to Fannie Mae or Freddie Mac. So FICO has this incredible leverage.
So when mortgage activity picks up, as we saw in this quarter, FICO captures that value through volume and price.
Yes. It's almost like a tax on the financial system. You want to lend money in America, you pay the FICO tax. And that 36% B2B growth is the result.
So we have the scores engine just firing on all cylinders, printing cash. But you mentioned a tale of two cities.
Right.
That implies there's another part of the business that maybe looks a little different.
And that brings us to the software segment. And honestly, if you were a casual observer and you just glanced at the headline number here, you might be, well, underwhelmed.
I'm looking at it now. Software revenues were $207.5 million, up only 2% year over year.
Right. 2% growth. Compared to the 29% we just saw in scores, that feels weak. Is the software business stalling?
See, this is the trap. This is why we do the deep dive. If you just read the top line, you completely miss the actual story. The software business isn't stalling at all. It's in the middle of a massive, deliberate transformation.
Okay, explain that. How does 2% growth hide a massive transformation?
You have to look at how they break down the annual recurring revenue, or ARR. FICO is essentially pivoting the entire company from old legacy software,
The on-premise stuff.
the on-premise stuff, exactly, what they call non-platform, to their modern cloud-based platform technology.
So this is the classic tech pivot. It's like when Adobe stopped selling you a CD-ROM in a box and forced everyone onto the Creative Cloud subscription.
That's a great analogy. Or Microsoft moving everyone from local Exchange servers to Office 365. It's painful in the short term, but it is incredibly lucrative in the long run. And the numbers prove it's working. In the report, platform ARR grew by a staggering 33%. Whoa, 33%. That's startup-level growth again.
Yes, but non-platform ARR, the old stuff, that declined by 8%.
So the 2% total growth is basically just the net result of the new stuff growing like crazy and the old stuff slowly dying off.
Precisely. The explosive growth of the future is being masked by the planned obsolescence of the past. If you're looking at the health of the business, you only care about that platform growth.
So what is this platform actually?
Sure.
Scores is easy to understand, but what software is FICO selling to banks?
It's decisioning software. I mean, imagine a bank. They have to make millions of decisions a day.
Like, should we approve this credit card transaction?
Exactly. Or is this login attempt fraud? Should we offer this customer a credit line increase? How do we collect on a debt efficiently?
They need an automated brain to do all that.
And historically, banks bought different pieces of software for different problems. FICO Platform is a unified environment where they can build all these decision flows in one place using all their data.
So it's sticky. Once you build your bank's brain on FICO's platform, you aren't leaving.
Sticky is an understatement. And there is a metric in this report that proves just how locked in these customers are. It's called the dollar-based net retention rate, NRR.
Okay, what does NRR tell us in plain English?
It tells you how much your existing customers are spending compared to last year. If your NRR is 100%, they're staying flat. Anything over 100% means they're spending more.
Okay, so what's the number for FICO's platform?
It's 122%.
122%. So the customers who are already on the platform are, on average, spending 22% more than they did a year ago.
Correct. They're not just staying, they're expanding.
That's incredible. That's like me signing up for Netflix and then a year later voluntarily paying them 20% more because I'm using it so much.
It implies that banks are adding more modules or processing more volume. They might start using the platform just for auto loans. Then they realize it works great, so they add credit cards. Then they add fraud detection. It's a classic land and expand strategy.
That is a key indicator of product health that the headline number completely misses.
Deepening their claws is a vivid way to put it, but yes, it creates a very stable, compounding revenue stream for the future. And unlike the scores business, which can fluctuate with the mortgage market, these software subscriptions are generally consistent.
So let's zoom out. We have the scores business, a cash cow,
Hmm.
and we have the software business, which is successfully migrating everyone to a high-growth platform.
Right.
What does this mean for the bottom line? This company must be sitting on a pile of cash.
They are incredibly efficient. Looking at the cash flow, net cash from operating activities was $174.1 million for the quarter,
Wow.
and their free cash flow was $165.4 million.
And they don't have to build factories. They don't have to ship heavy machinery. It's just code and data.
It's a capital-light business model. So the question you should always ask when a company generates this much excess cash is, what are they doing with it?
Right. Are they buying other companies? Building a spaceship?
They are buying themselves.
Stock buybacks.
They're huge ones. In this quarter alone, they repurchased $171 million of their own stock.
Wait, hold on. They generated $174 million in operating cash, and they spent $171 million on buybacks.
Essentially, yes. They are returning almost 100% of their cash flow to shareholders by reducing the share count.
That is aggressive. Why do that instead of saving the money or investing in R&D?
It signals extreme confidence from management. They're effectively saying, we don't see a better investment out there than our own stock. They are confident the cash faucet will keep running.
And that helps investors because it slices the pizza into fewer pieces.
Exactly. Even if total profit stays the same, fewer shares means the earnings per share goes up. Remember that $6.61 EPS number? Buybacks are a mathematical lever to keep pushing that number higher.
It seems like management expects these good times to keep rolling. I saw a quote here from the CEO, Will Lansing. He didn't sound worried.
No, he was quite direct. He said, we had a good start to our fiscal year, reiterating our fiscal year 2026 guidance, which yields stronger growth than we achieved in FY25.
That reiterating part is key. Sometimes companies have a blowout quarter and say, don't get used to it.
Right, that was a one-time thing.
But here, by reiterating the full year guidance, they're saying, yes, this performance is exactly what we planned.
And let's look at those targets. For fiscal 2026, they are aiming for $2.35 billion in total revenue and GAAP net income of $795 million.
Almost $800 million in profit on $2.3 billion in revenue. That margin is beautiful.
It is massive. And remember, Q1 is just the start. If the mortgage market holds up and the platform software continues at 33% growth, those targets look very achievable.
It's just interesting how steady the guidance feels. There's no panic, no frantic pivoting, just here's the plan, here's the cash, we are buying back stock.
It's the confidence of a company with a dual-engine business model. Even if one side slows down, say mortgage rates spike, the software side is recurring revenue that helps stabilize the ship, but right now, both engines are firing.
So what does this all mean for us? Besides the fact that FICO is way more than just a 3-digit number.
I think the big takeaway here is about leverage and position. FICO has positioned itself as an indispensable utility.
A utility, like the electric company.
In a way, yeah. Think about it. You can't really run a consumer lending business in the U.S. without FICO scores. That's the utility part. But unlike a regulated electric company, FICO has pricing power.
Right.
They can raise rates without losing customers. And with the platform software, they are trying to become even more essential.
Trying to become the operating system for the bank's decision-making.
Exactly. If they succeed, and that 122% retention rate suggests they are succeeding, they become virtually impossible to rip out.
It's a lesson in business pivots, isn't it? They kept the legacy cash cow, the score, extremely healthy. But they didn't just sit on that and count their money. They used that stability to fund this massive tech stack.
A lot of companies fail at that. We've seen it a dozen times. Kodak, Blockbuster, they either let the cash cow die while chasing the new thing, or they cling to the cash cow and miss the future. FICO seems to be balancing both. They are migrating customers to the future without killing the golden goose.
It really changes how I look at those earnings reports. I used to just look for the biggest number in bold print. But seeing the difference between platform and non-platform growth completely changes the story.
It's always in the details. The boring 2% software growth was actually a thrilling 33% growth story in disguise.
Which brings us to the end of our deep dive today. We've looked at the $500 million in revenue, the pricing power, the hidden transformation.
It is a strong start to their 2026 fiscal year, no doubt.
But here is a thought I want to leave you with. It's something I've been mulling over since we started talking about this platform concept.
Go for it.
If FICO continues this trajectory, if the retention on their software stays at 122%, and the mortgage market keeps relying on their scores, Does FICO stop being just a credit score company?
That is the big question.
Right. If they are running the software that banks use to make decisions and they provide the data for those decisions, do they eventually become the central brain for the entire banking industry?
They certainly seem to be building the infrastructure for it. If you control the score and the decision engine, you control the flow of credit.
And that is a powerful place to be. It's definitely something to think about the next time you worry about that three-digit number.
Yeah.
It's not just a score, it's part of a massive financial ecosystem that is growing double digits.
And buying back its own stock while doing it.
Exactly. Thanks for listening to this deep dive into FICO's Q1 2026 earnings. Hopefully next time you see a boring financial report, you'll dig a little deeper to find the hidden gems inside.
There is always a story behind the numbers.
We'll catch you on the next one.